Hey everyone, welcome back to Corporate Decoder, the place where we unravel the secrets hidden within those dense corporate filings. And today we're diving deep into NewGenIvf Group Limited's latest report, a company that operates in the very personal world of fertility services. Get ready because this filing definitely has some surprises, from ambitious expansion plans to some truly eyebrow-raising investments. Before we jump in, if you like cutting through the corporate jargon to get real insights, hit that subscribe button. And if you want to chat about these findings with fellow finance enthusiasts, join our Discord community linked in the description below. So, NewGenIvf filed an amendment to their Form F-1 registration statement. This is essentially a public announcement about selling shares, and it gives us a peek into their current financial health, their strategies, and crucially, their risks. Right off the bat, they're talking about offering up to 50 million Class A ordinary shares. That is a lot of shares, and it signals a significant move by the company, likely to raise capital or allow existing shareholders to cash out. NewGenIvf Group Limited is a British Virgin Islands holding company. Think of it as the parent company, with its actual operations happening in places like the Cayman Islands, Asia, and the United States, with most of their business in Thailand, Cambodia, and Kyrgyzstan. They're in the business of assisted reproductive services, or RRs, basically helping people who are having trouble conceiving. Now, this is interesting. The company mentions regaining compliance with Nasdaq's minimum bid price rule. This is a big deal because failing to meet this could lead to being kicked off the stock exchange. They did this by doing a reverse stock split, which is basically consolidating shares to make the price per share look higher. It doesn't change the overall value of the company, but it can help them stay listed. Let S jump into the numbers themselves. Looking at their consolidated balance sheets as of the end of 2024 and 2023, we see a company that is definitely navigating some financial challenges. Their total assets were about $3.6 million in 2024, down from around $4.5 million in 2023. Meanwhile, their liabilities jumped significantly from about $1.2 million in 2023 to over $5 million in 2024. This is largely due to the convertible notes they issued, which are essentially debt that can be turned into stock. That increase in liabilities is a key takeaway. It means the company has taken on more debt, which can be a good thing for growth if managed well. But it also increases financial risk. Even more striking is their equity situation. In 2023, they had positive equity of about $3.7 million attributable to shareholders. But by the end of 2024, that had swung to a deficit of over $1 million. This means that on paper, the company owes more than it owns. This equity situation is directly reflected in their income statement. In 2023, they showed a net income of about $130,000, but in 2024, they reported a net loss of nearly $525,000. This indicates a significant downturn in profitability in 2024 compared to the previous year. The auditor's reports are also worth noting. For the 2021 and 2022 statements, there is a clear emphasis of matter stating substantial doubt about the company's ability to continue as a going concern. This is a serious warning from the auditors. While the situation improved by 2023, showing positive shareholders' equity, they still had a working capital deficit. For the 2024 statements, the auditors again highlight substantial doubt about their ability to continue as a going concern, citing a significant accumulated deficit and deficit in shareholders' equity. This is a recurring theme and a major red flag. Now, alongside their core fertility business, NewGenIvf is making some rather unconventional strategic moves. They announced plans to invest up to $30 million in staking Sol, the digital currency of the Solana network. This is a high-risk, high-reward strategy in the volatile world of digital assets. They've already acquired about 13,000 Sol tokens, valued at around $2.9 million. The company sees this as a way to generate returns through staking rewards and potential appreciation in Sol, S value. But the risks here are enormous. Sol's price is incredibly volatile, swinging wildly in the past year. There are also staking and liquidity risks, meaning they might not be able to sell their Sol quickly if needed. Then there are operational and validator risks, where the performance of third-party validators they delegate to could impact their earnings. And let's not forget custodial and security risks. Even with a reputable custodian, there is always a chance of losing assets due to breaches or insolvency. Plus, the regulatory landscape for digital assets is still very uncertain. The filing goes into detail about the specific risks of the Solana network itself, like potential network outages, software vulnerabilities, and competition from other blockchain technologies. They acknowledge their management team has limited experience in this sector, which adds another layer of risk to this aggressive digital asset strategy. Diving into the risks, it is clear the company faces many challenges. The fertility market is competitive, and they admit it could be hard to succeed if they don't keep up. They have a limited operating history with their current solutions, making future predictions difficult. Their international operations in Thailand, Cambodia, and Kyrgyzstan are subject to economic and legal uncertainties in those countries. And a recurring concern is their reliance on international clients, especially from China, making them vulnerable to global travel disruptions, as seen during the COVID-19 pandemic, and even to negative publicity from events like crime thrillers or real world security incidents occurring in their operating regions. Another significant risk is their continued listing on NASDAQ. They've had multiple deficiency notices, including for minimum bid price, market value of listed securities, and market value of publicly held shares. While they've regained compliance with the bid price rule for now, any future slip-ups could lead to delisting, which would severely impact liquidity and their ability to raise further capital. On the leadership front, the management team is noted for its experience in the ARS market. Wing Feng Alfred Siu, the CEO, and Hai Yue Tina Fong, the CMO, are husband and wife, which could present related party transaction risks, although the report does mention some of these balances are being repaid. The company operates in a highly regulated industry, and compliance is a major concern. They must navigate complex and evolving laws in multiple countries regarding licensing, patient rights, data privacy, and more. The filing specifically mentions the risks associated with advertising gender selection services, particularly in Hong Kong, where it is prohibited and has led to arrests of company executives. While they state they don't market these services directly in Hong Kong, the investigation and potential charges against executives, including the CEO, are a serious development that could impact the company's reputation and operations. Scroll consolidated statements of operations and comprehensive income. Loss for the years ended the 31st of December 2024, 2023, and 2022. Feinstein looking at their financial performance over the last few years. The trend is concerning. Revenue has been relatively flat or growing slowly from about 5.1 million in 2023 to 5.4 million in 2024, after being higher at 5.9 million in 2022. However, their costs and expenses have surged. They went from a net income in 2023 to a significant net loss in 2024. Their operating expenses, particularly general and administrative expenses, have more than doubled from 2023 to 2024, largely due to business combination costs and expansion efforts. This has led to a substantial drop in net income attributable to shareholders, from a positive figure in 2023 to a significant loss in 2024 and a worsening net loss in the first half of 2025, according to the unaudited statements. The company's strategy to invest heavily in new areas like digital assets and real estate in the UAE, while potentially offering future growth, also adds significant financial strain in the short term. So, what is the story here? NewGenIvf is in a critical phase. They retrying to grow in the competitive ARS market, expanding their services and locations, which is good. However, they refacing significant financial headwinds, as evidenced by mounting losses and a negative shareholders' equity. The move into digital assets and real estate is a bold bet, but it introduces a whole new set of complex risks, and it is happening while they still trying to stabilize their core business and maintain their stock exchange listing. The recurring going concern warnings from auditors cannot be ignored. While their core fertility business has a solid foundation, the company's ambitious diversification and the sheer scale of recent financing and investment activities, coupled with the regulatory scrutiny and potential legal issues for key executives, paint a picture of a company at a crossroads. They need a masterful execution of their strategies and a careful balancing of risks to achieve sustainable profitability and long-term success. That is our breakdown of NewGenIvf's latest filing. What are your thoughts on their aggressive expansion and digital asset strategy? Do you think they can overcome their financial challenges? Let me know in the comments below. If you found this deep dive valuable, please hit that like button and subscribe for more corporate analysis. And don't forget to join our Discord community for more in-depth discussions. Thanks for watching, and we see you in the next episode of Corporate Decoder.